Most traders think they lose money because they can't predict the market. But in many cases, that's not the real problem. The real problem is timing. They spot the right direction, but they enter too early. Or they wait too long and miss the best opportunity. That's exactly why the ABCD pattern has remained popular for years. It's simple, structured, and gives traders a clear framework for planning entries, stop losses, and profit targets. And the best part, you don't need complicated indicators or advanced algorithms to use it. In this video, I'll show you exactly how the ABCD Harmonic Pattern works, how to identify it inside TradingView, how to measure it correctly using Fibonacci tools, and most importantly, the mistakes that cause beginners to misuse it. Let's jump right in. The ABCD pattern is one of the simplest harmonic patterns you'll find. At first glance, it looks like a zigzag move in the market. Price makes an initial move. Then it pulls back. Then it makes another move in the original direction. Those four turning points create points A, B, C, and D. Think of it like a runner. The runner sprints forward, stops briefly to catch their breath, then continues running again. The market often behaves in a similar way. Now here's where things get interesting. Not every zigzag is a valid ABCD pattern. The pattern becomes valuable because of its relationship with Fibonacci ratios. These ratios help us identify areas where price may react. And that's what gives the pattern structure. Let's start with the first leg. The move from A to B is the impulse move. This is the initial burst of momentum. Next comes the retracement from B to C. This is where many beginners make mistakes. They assume any pullback is acceptable. But the ABCD pattern requires a specific type of retracement. Inside TradingView, grab the Fibonacci Retracement tool. Measure from A to B. Now look at where point C forms. A strong ABCD setup often has point C near the 61.8% or 78.6% Fibonacci retracement level. These aren't magical numbers. They're simply areas that traders around the world watch closely. When enough traders focus on the same levels, reactions become more likely. Once point C is established, we can estimate where point D may form. This is where the Fibonacci Extension tool becomes useful. Measure from B to C, then project the next move. Many traders look for the 127.2% or 161.8% extension levels as potential completion zones. Notice something important here. We're not predicting the future. We are creating a roadmap. Big difference. The market can still do whatever it wants. The pattern simply highlights areas worth paying attention to. And that brings us to one of the biggest mistakes beginners make. They enter a trade before price reaches point D. That's often a costly mistake. The ABCD pattern is not complete until point D forms. Until then, it's only a possibility, not a signal. A much better approach is to wait for confirmation. Maybe you see a strong rejection candle. Maybe momentum starts slowing down. Maybe price breaks a small structure level. Those clues can help confirm that buyers or sellers are stepping into the market. Let's look at a bullish example. Imagine a stock rallies from point A to point B. Price then pulls back into the 61.8% retracement area. That creates point C. Next, price starts moving higher again. As it approaches the 127.2% extension, we begin paying close attention. We don't blindly buy. We observe. If buyers defend the area and price starts showing strength, that may provide a potential setup. At that stage, many traders place their stop loss below the recent swing low. Why? Because if price continues breaking lower, the pattern may be invalid. The market is telling us our idea was wrong. And that's completely fine. Good trading isn't about being right all the time. It's about managing risks. Now let's discuss targets. One mistake many traders make is expecting every trade to become a home run. In reality, taking partial profits can be much more effective. Many traders scale out of positions. Some take profits at the first major retracement level. Others leave part of the trade open in case a larger move develops. This approach helps reduce emotional decision-making. Now let's switch to a bearish example. The same concept applies, just upside down. Price rallies from A to B. It retraces down to form point C. Then buyers push the market higher once again. As price reaches a projected extension zone, we start looking for signs of exhaustion. Maybe we see long upper wicks. Maybe momentum weakens. Maybe sellers suddenly step in. Those clues can signal a potential reversal. The structure remains the same. Only the direction changes. One reason traders like the ABCD pattern is because it naturally creates attractive risk-reward opportunities. If your stop loss is relatively small and your target is significantly larger, you don't need a high win rate to potentially stay profitable. That's why risk management matters more than prediction. Now let's cover a few common mistakes. Mistake number 1. Forcing patterns that aren't actually there. Sometimes traders want to find an ABCD pattern so badly that they start drawing points wherever they want. If the structure isn't clear, skip it. There will always be another opportunity. Mistake number 2. Ignoring the overall trend. An ABCD pattern that aligns with a larger trend often has a higher probability than one fighting against it. Always zoom out and understand the bigger picture. Mistake number 3. Using the pattern by itself. The ABCD pattern can be powerful, but combining it with support and resistance, market structure, or volume analysis can improve decision-making. And mistake number 4. Entering before confirmation. Remember, potential and confirmation are not the same thing. Patience is often what separates disciplined traders from emotional traders. The goal isn't to trade every pattern. The goal is to trade quality setups. The ABCD pattern gives you a structured way to identify those opportunities. It helps to find where you might enter, where your risk may be located, and where profits could potentially be taken. That's why it's often one of the first harmonic patterns traders learn before moving on to more advanced structures. If you're new to harmonics, spend some time practicing this pattern on different markets. Try it on stocks. Try it on Forex. Try it on crypto. The more charts you review, the easier it becomes to recognize high-quality setups. And remember, no pattern guarantees success. But having a repeatable process is far better than guessing. If you found this tutorial helpful, let me know in the comments. Have you ever used the ABCD pattern before? And if so, what market do you trade most often? Don't forget to like the video and subscribe for more TradingView tutorials, technical analysis strategies, and practical trading education. Thanks for watching, and I'll see you in the next one.